Hello everybody, welcome back. Today is the third lesson of my series of lectures that I have been recording. In my last video, we talked about gold standard and how the banking industries worked on fractional reserve basis. So we did talk about that when initially countries came up with the fiat currency. They had their money, they had currency backed by gold. When we talked about dollar in particular, somebody actually made a comment on the video saying, the dollar is not backed by gold. Everybody keeps saying this. And I said I was just giving an introduction of what it means to have gold standard. I haven't gone into the breakdown of whether any of the currency in the world is backed by gold or not. We're going to do this in this video. So let's talk about that. First thing first, if you recall, I did mention that when the countries had decided to come up with fiat currency, they had dollar as a backing. So if I had $1 million and tomorrow the government decided they're not going to use fiat currency anymore, I could go to the bank and say, take the $1 million and give me my gold of equivalent amount. Let's say 1 gram of gold was $100. That's how we calculated the price. Now let's talk about whether the fiat currency is actually backed by gold or not, whether we still have gold standard or not. We did have gold standard up until 1971. In 1971, when Nixon was printing lots of money to fund Vietnam War, the countries in the world were kind of a little reluctant, and they said, "Well, you're printing more dollars than you have the gold in your strategic reserve to back it." And they all started claiming their money back. And now the question will arise: why did the other companies have the money in the U.S. in dollar form? So we all know the dollar has been the currency of exchange at the global and national and global markets. So whenever the countries import or export something from other countries, they make payments in dollars. No other currency is acceptable or was acceptable for a long time. I mean, with the exception of few country, dollar is still the currency that's used at the international market. So for example, I'll give an example. When we import oil from Saudi Arabia or from the Middle Eastern countries, we pay them in dollars. Those countries then take the dollar, and if they take them back to their home country, the dollar is of higher value than their own currency. So that is going to reduce the value of their own currency. So what they do is they buy Treasury bonds, the U.S. Treasury bonds, and then they invest the money in there. So what does that mean? That means the money that they've earned by exporting oil to USA, and US made the payment to them in dollars, those governments, those countries will take that dollar amount and they will say, okay, we're going to give you our dollar that we just made from you by selling you oil, and we're going to take the US Treasury bonds, because the Treasury bond is a promissory note that the government issues to pay you your money back in the next 5 or 10 years, and then they also promise to pay you a surplus, a profit or interest or usury or riba, whatever you want to call it. And those countries and companies and individuals, they buy Treasury bonds and they give their dollars to the government, and they buy those bonds with the promise that they will make secure 5%, 10% in the next 5 to 10 years. So ultimately, all the currencies were backed by gold in that case, because every country was importing and exporting in dollars. So whenever they had their money, when they go to the international market, they basically get dollars, but then they give their dollar back to the US and buy Treasury bonds. So ultimately, all the currencies are backed by gold, because everything has to convert to dollar in order for them to import and export. So therefore, when in 1971 Nixon printed so much fiat currency to fund the Vietnam War, the other countries who had treasury bonds from the government, they said, well, we want our money back because you don't have enough gold to back all this dollar that you're printing. So on August 14th, I think, or August 15th, 1971, Nixon announced the dollar is no longer be backed by gold. So the gold standard from the dollar was removed. And the reason being was he wanted to be able to print excessive amount of money or currency to fund the Vietnam War. Next video I'm going to make on treasury bonds and how this works, and then you guys will understand it better. But for now, for this part of the video, that whether dollar is really backed by gold or not, I had to kind of um, make it very a short explanation of how this works. So in 1971, since 1971, our dollars are not backed by gold, and that gives the government the free hand to print unlimited amount of currency whenever they need to, or whenever they think the economy needs a boost. They just, in the name of quantitative easing, they just print money. What are the side effects of printing this excessive amount of money? So in 2019, COVID, 2020, we all got, people who qualified got stimulus checks. Businesses got, checks from the government. Certain $1 trillion was printed to kind of give a boost to the economy because people were losing their jobs. Businesses were being shut down. So in the name of quantitative easing, that's a fancy name for printing more money. Government printed, I don't know how many $1 trillion, and they're distributed to that wealth into the economy. That money that we received, and we were so happy that I got stimulus check and it's free money. That money was not free. When our government prints free money, that dilutes the value of the money, which means that the value of money goes down. So if something used to cost us $1, it's going to cost us $2 now. So that money that we get for free is really not free. We are paying for that free money now in the form of inflation and in the form of taxes. So whenever the government prints money, because the currency dilutes, the value of money goes down, and so as a result, inflation goes up, and not only us, but our generations to come have to pay the price in the form of inflation and higher taxes. When we go to the super, people are saying, "Oh my God, things are so expensive, inflation is so high." Commodities don't get expensive. Commodities, the prices stay the same. The reason why it becomes so expensive, because when you have excessive amount of wealth floating in the economy, the value of currency goes down, which means if I went to the grocery store and it cost me $100 to pay for my weekly groceries, my groceries are still the same price. Avocado is still 69 cents as it was last year and year before, that bag of sugar is still the same price. The problem is now our money, because there was excessive supply of money, it has lost its value. So now whatever used to cost us 69 cents, now it's going to cost me maybe $1.20. And I'll explain this to you in a sense. If you take, so I was reading an article a few years ago, I don't remember how long ago was it, and this said if you had $100 in 1900, by 2000 that $100 will lose 97, sorry, will be only worth $4, which means you lost 96% of the value of that $100 over the course of just 100 years. Versus if you take gold, the sound money, gold, silver, or any other kind of sound money that has been produced. So gold was mostly used as a sound money. If you take 1 gram of gold, whether it was 100 years ago or 50 years ago, whatever commodities you could buy with 1 gram of gold, then you can still buy the same commodity and same things for that 1 gram of gold. Why? Because gold has store of value. The sound money, remember we talked about sound money and how it has store of value? Sound money has store of value, and the reason being is it's very hard to extract from the ground. Sound money needs proof of work. It needs lots of effort and hard work, and it costs money to produce sound money. Whereas uh, the fiat currency doesn't need any proof of work, and it's not sound money because it doesn't take effort and hard work and cost to produce new money. I mean, right now we create money digitally, which means we don't even have the printing cost anymore. With just a click of a button, we just add so many extra zeros and this many $1 trillion are floating in the economy. So, and because it's not backed by gold, and gold standard was removed in 1971 by Nixon, it kind of gives the government free hand to print money whenever they desire to print it. Now let's talk about the banking industry and how banking industry is involved. So what happens when government decides to print more money? So the fiat money is created when the countries are going through economic crisis. For example, COVID-19 was an economic crisis. Businesses were being shut down. schools were closed, people were losing their jobs because companies were not making any money. And at the individual level, households were struggling, so government decided to print more money. So the government asked the Federal Reserve to turn on the printer and give me more money. So government borrows money from the Federal Reserve and it gives them a promissory note. And that promissory note says, I will pay back this money in the next 5 years or 10 years, and I'll pay you the profit on top of your money, which is 5%, 10%. That promissory note, they're called the Treasury bond or the US government bonds. So that US government bond is just a promise to pay back the original principal to the Federal Reserve and the interest on the money that they've borrowed. This is a small piece of a puzzle of a very large Ponzi scheme. Let's talk about what Ponzi schemes are. Ponzi scheme is you take a group of people, you say, okay, you give me your money, I'll double your money in 5 years, I'll give it back to you. So you take that money, then you go to the other group of people and you ask them the same thing, you give me your money, I'll double that money for you in 5 years and I'll give it back to you. So you take the money from the second group, you pay the first group, at the end of 5 years, then you go to the third group of people and you say, you give me your money, let me borrow your money, I'll pay you your money back plus the surplus or profit on that money. So now you just take money from one person to the next and give it to the next person. You're not actually generating any wealth. You're not investing that money to be productive or to create more business, to create more jobs. You're just taking money from one person and you pay it to the next one. And this cycle goes on until you have no more people left who you can take money from and fulfill the promise. So you've been paying those people at the top who initially invested with you or gave you the money with the promise that they will get back their money plus the surplus. At the bottom, the last group of people, now you have no money to pay them back because you've already taken money from them and you paid to the people before them. That people at the end are going to be left with nothing and they lose their wealth. So that's the Ponzi scheme. Whereas the real investment is, I could come to you if you really trust me. And in this case, people trust government. So if I was a government, I come to you and say, hey, you give me your dollars, I'll create new businesses, I'll invest that money into more productive businesses and industries, and I'll create job and I'll create wealth, and then I'll give you 5%, 10% profit in the next 5 to 10 years. And that's called the real investment. Now let's see how these US Treasury bonds are a Ponzi scheme. That's exactly what the government does. They ask the Federal Reserve to print money whenever they need more money. So they take that extra $1 trillion or multi-trillion dollar, they give it to the federal bank, and then they issue a Treasury bond, and it's just a promise because the federal Reserve trusts the government, saying that whenever they promise, they'll pay us back. So they issue like a promissory note saying they will pay you back your original $3 trillion that you just gave us and 5% surplus on that money. They use that money within 5-6 months. They go back to the Federal Reserve and say, give us $6 million more. We'll give you that back plus the surplus in the next 5 years. So this time the government doesn't need just the $3 trillion, but now they're going to ask for maybe $7 trillion because they have to pay back the $3 trillion that they borrowed from Federal Reserve, plus the surplus, plus they need another $3 trillion to run the country or pay their bills. So they keep on, so they take this $7 trillion, they pay the Federal Reserve their initial $3 trillion plus the surplus, and then they take another $3 trillion to pay their bills. They come back in 6 months or 8 months. And this cycle goes on, and Federal Reserve keeps printing money, keeps giving it to the government. Government keeps issuing those treasury bonds or promissory notes or treasury bonds. Once the Federal Reserve has so many treasury bonds accumulated from the government, they go out and they auction those bonds to other countries, big ETF managers, hedge fund managers, and to individuals. If you ever watch financial news, you probably do realize that people say, oh, the US Treasury bonds have gone up, the rate have gone up, or US Treasury bond rate have gone down, the 10 years bond or 5 years bonds are going up or down. And that's what those treasury bonds are. Other countries, as I mentioned before, when they do an export of their products and services, they get paid in dollars. Then they take that dollar and they lend it back to the government of the US, and they say, okay, give us your treasury bonds because government is promising to pay back in next 5 to 10 years their original um, amount that they borrowed from those countries, plus the interest that they have promised, whether it's 5%, 10%. Of course, 5 years Treasury bonds are going to give them lower profit. The 10-year Treasury bonds are going to give them higher profit. So those countries then lend that money back to the government, and then after 5 years they come back and demand their money. Now government goes back to Federal Reserve and says, print more money, turn on the printer. We need the money because we have to pay Saudi Arabia. We give them the Treasury bonds, and then we'll pay you back. So every time government goes back to the Federal Reserve has to print double or triple the amount of the money, and they just keep taking the money from the government and paying it back. From the Federal Reserve and paying it back to them, but they're not actually generating any wealth. They just pay their bills, they fund the wars with their money, and they keep issuing the promissory note, which is a large Ponzi scheme and a form of a fraud. It's just so obvious, but the problem is the common man doesn't understand what it means to have Treasury bond. They think, oh, government is paying us interest. They're not. They're basically taking money from the Federal Reserve, which is costing you money in the form of inflation, and they charge you higher taxes because now they need more money from people to run the country and pay their bills on top of, and that's why the US is always running on deficit. They never have enough money. They're always, no matter how well the economy is doing or how bad the economy is doing, the country is always running on deficit. So that's what these treasury bonds are. It's a very large Ponzi scheme, and this Ponzi scheme is going to end at some point, and people are going to be left with holding the bag and losing all their wealth at the end, because it's been proven in the history that fiat currency has 100% failure rate, and our economy, I often, whenever I read about these things and I see how much new currency is being printed and how this is going to dilute the value of the money and how inflation is spiking up so much, it just seems to me like the U.S. economy is a financial ticking time bomb. And when this time bomb goes off, it's not only going to affect the U.S. economy, but it's going to affect the global economy as well, because all the other countries are dependent on the US economy because they trade with dollars. And when the dollar is diluted, it loses its value. And when it crashes, it's going to crash everybody. It's going to affect everyone in the world. And that's a very big problem that we are waiting to happen. So before that happens at an individual level, I think we should be smart and we should take charge of our own finances. That's why if you look at all these very filthy rich people, they don't hold dollars. They don't hold currency in their bank account. They invest their money into some tangible commodities, either whether it's real estate, whether it's gold, it's Bitcoin now, that's like digital commodity or digital item that they're considering because it's very scarce. It's it needs proof of work, and it has store of value, so people are investing into Bitcoin now. So all those top 2-3%, the rich people, they don't hold dollars, they don't hold currency. They always invest into something else which is more sound and which is tangible and which is store of value. And that's what we need to do as an individual. So now how are the banks involved? When government gets the money from the Federal Reserve and they print money, they basically give it to the federal bank, and those banks then distribute it to all the other banks. Now banks have this excessive amount of money, so they lower the interest rate and they have cheap money available. So as during COVID, what happened, the interest rates went down because government had printed so much money. So banks had this extra money for them to lend to people, and we already learned about how banking industry works. So for every dollar that they receive, they can lend up to $1,000. They just create money out of thin air, so they have even more money than the federal government has printed. And then they lower the interest rate. So who gets access to that money first? The very people at the top, they get access to that money first. So they take that cheap money and they go out and invest into real estate, into gold, into other tangible commodities. And what happens is the prices of those tangible commodities go up, and by the time they've already used so much money, the interest rates start going up gradually. So by the time it comes to the common people like you and I, we have missed on the boat on those tangible commodities, cheap prices, and we didn't get the the interest rate that those top 2-3% have gotten, because they've already utilized most of that money, and they don't just borrow 100,000 or 400,000. They borrow in billions and trillions because they have bigger investments to make. So like lots of these ETF managers and hedge fund managers, they actually borrow money from the bank and then they invest them into these equities, into this into the stock market. So it's not their own money, and that's what they do. And therefore, because they're the top beneficiaries of this Ponzi scheme, they don't want this to end. They don't want this fiat currency to end, and they don't want to get away with the Federal Reserve. In 2008, this economic crash took place. I can make a whole entire video, like 2 hour long video on that 2008 economic crash. That was another big fraud that took place at a very next level. People didn't understand what was going on, but they started realizing the federal government is the problem, and people had a protest against the federal government. They said, get rid of the Fed. And I agree, get rid of the Fed. Fed is the problem. They are the one who keep printing the money, keep lending it to the government, and keep increasing the prices and inflation. And we, as a common man, we are suffering every day. People are working 2 jobs and 3 jobs, and there are 7 people in the family, and they're all working, and they're just servicing their debts. So anyways, back to the banks. So by the time we get that money, let's say during COVID, the housing was cheap. I know when there was COVID shutdown, there were so many houses in the market and there was no buyer. The prices kept declining. Then suddenly government prints the money. The stimulus checks were issued. The banks were bailed out. The businesses were bailed out. The airlines were bailed out, and all this money was floating in the economy. Now suddenly all the houses were just being sold within hours. And what happened? The demand went high because there was cheap money available for people to borrow from the bank at a lower interest rate, because there was extra flow in the economy. And then the prices of houses just started going up. So people had to pay double the price sometimes, and a few $100,000 extra to buy the house that they could have bought cheaper a few months ago. But because the money comes to us as a layman person, as a common man, very late, so we're always late to the circle. And what happens then? Those rich keeps getting richer and poor keeps getting poorer. So middle class always stays middle class, and lower class always stays lower class. And those top 2-3%, we can never catch up to them. So of course they're not going to get rid of the system because it's making them the most wealth. They're becoming the wealthiest. So, and all that money that was created, we are paying the price for it now. Inflation has gone up, the housing market has gone up, and now finally, because there was so much inflow of the currency in the economy, now suddenly government has to increase the interest rates, and when the interest rates go up, now people can't afford to buy a house because everything is too expensive now. They go and try to get the loan. The loans are expensive because before you only pay 2% on your loan. Now you have to pay 7%. So people can never afford to buy the tangible commodities that they wanted to buy. When this keeps happening and this Ponzi scheme continues, at some point this system has to collapse. And when that system collapses, it's a bigger chaos in the world that you and I can even imagine. People will kill each other. People will just go and fight for tangible commodities because they know whatever they can buy now for $1, by noon it's going to cost them $2. That's what happened in Venezuela. I mean, if you look at their currency, they take a bag full of money and they don't buy anything with it. So now their money is useless. They're just making them as a wallpaper. They're using that money to, I don't know, lit their cigarettes because money has no value. And that's exactly what happens to fiat currency. So therefore, there has to be a decentralized economy and deregulated financial system in the country, which is going to help stabilize the economy, and it is going to help distribute the wealth among in the economy at a more reasonable ratio. Right now, the poor, they never catch up. The rich, they're just so far ahead of us that we just always we can just think about them. We don't even know who those people are, and that's what's causing the inequality in the system, in the society, and at some point this system has to collapse. Now let's talk about banks, and this second part of the video I'm going to make, this is for basically for teenagers. There are how banks make money. We talked about that they make money by lending excessive amount of money because they work on fractional reserve basis. Then they make money because the Federal Reserve gives them the money. They lend it at a cheaper price, at a lower rate. So people take more debts than they can afford, and then they work 2, 3, 4 jobs, or everybody in the family is working job to service those debts, and they're paying the banks all their lives pretty much. That's another way the banks make money. And there's a third way the banks make money. When I was working at a bank, it's like 20 years ago. I wasn't a very religious person at the time. I'm a Muslim. My faith is Islam, but I wasn't a practicing Muslim, I should say. I didn't know much about riba and interest and how it impacts the society, and I didn't even know that it was prohibited in our faith, because I was one of those young bankers who just didn't care. But the one thing that did bother me was my branch where I used to work was very close to one of the colleges. And so many parents will come from other states and cities to have their children settle down, and they will come to our branch because my branch was very, like, really walking distance from uh, the main campus. And they will walk into our office and they'll say, I need to open a bank account for my son or for my daughter. So I will open the account for them. So parents, they'll deposit a certain amount of money in their children's bank account, and I will issue them a debit card, and they'll say, okay, now you have enough money, you have your dorm room set, and then they'll kiss them goodbye and they'll leave. And now these kids, they're just freshly graduated from high school. They don't know how to manage their finances because nobody teaches them at the school level. And parents sometimes, they don't even probably know how banking industry works. So they don't know. They just say, oh, make sure you don't spend more than what you have. But they don't understand how banks work. So Friday night comes, of course, students, they go party. And they only had, let's say, $100 in their account. Now they're young kids. They don't know how to keep track of their transactions. And the problem with the bank, the debit card that we issue, you can swipe it as a credit and the money comes out of your bank account. So usually those young kids, they had tendencies to go to an ATM machine at a club or a bar, and they'll check the balance and they'll say, you have $100. Okay, they're happy. They'll go to the bar, they'll party. But they don't realize that every time you use your debit card to check the balance, so let's say at the bar, it's a KeyBank ATM machine, but you have your account open at Bank of America. So that KeyBank will charge you a transaction fee because you used their service. And then your own bank, Bank of America, will charge you a $2 or $3 fee because you went to other ATM machine to check the balance. So they penalize you because they have to pay that bank a fraction of the payment. So you just lost $5, $6 right there just in checking your balance. Then when you swipe your card as a credit, it doesn't deduct the money out of your account right away. It just pre-authorizes the transaction, but it doesn't take the money out until a day or 2 days later. I mean, I don't know how it works now. Maybe now it's quick, but when I was working at the bank, it used to take 24 to 48 hours for that transaction to actually be debited from your account or be minus from your account. So those kids, they'll just spend the money. They'll go check the balance again, how much money I have left on Sunday. They'll say, oh, you still have $70, but they don't realize they just spent $50 last night at the bar. Then they'll go watch a movie or have dinner with their friends, and by Sunday night they already overdrafted their account, and now the bank has a free hand to charge them an overdraft fee. And then kids being kids, they don't check their balance every day. So until next time they go to an ATM machine to make a withdrawal, and ATM says, sorry, you don't have any more funds left. Then they come to the bank and they say, I had $100 on my account. What happened to my money? I was trying to withdraw $20, but it says you don't have any money left. And when we check their accounts, their account is overdrawn by, I don't know, $70 or $50, and now they're getting hit with the overdraft fees. Then if you don't pay your overdraft within 3 days, every third day you get charged a sustained overdraft fee, and then those fees are pretty hefty depending on what bank you have your account with. It's anywhere between $25 to $45. So you get hit with the $25 to $45 when you don't have the money and the bank is paying for those transactions. And on top of that, you're getting hit with another $35 to $45 every third day for sustained overdraft. And the other thing what banks do is, so let's say I had $50 in my account. I went and I bought movie tickets and popcorn and I spent 30 bucks on that. Now I had $20 left in my account. Next day I went and I ordered pizza for $21. So now I was missing $1. I had 20 bucks, but I paid $21. So I went and I paid, and other same day I went and I bought, I don't know, a piece of gum for 50 cents. And I went and bought candy for another $1. So what banks does is, and they all took place on the same day. So for every single time you used your card for whether 50 cents, whether it's for a penny, whether it's for 10 cents, it will charge you $35 overdraft fee. So kids will buy, and then what banks do is they always pay the largest transaction first, and then they pay all the small transactions afterwards. So let's say you have $20 in your account and you spent $1 on the candy, $1 on the gum, $1 on the soda, and then you spend $20 on pizza. It would be so much cheaper if bank had paid that candy $1, gum for $1, and then soda for $1, and then they had $17 left. Now they pay for the pizza. Now you only get hit with one overdraft fee of $35 because you didn't have enough money to pay for the pizza. Banks don't do that. They pay the largest transaction first. So even with the first transaction, since your pizza was $21, you already got hit with the $35 fee. Then they paid for the candy, you got hit with the $35 fee. Then they paid for your soda, so you got hit with the $35 fee. And when kids come to the bank and they will be crying because their account is overdrawn by $400, $500, in some cases up to $1,200 in overdraft fees and sustained overdraft fees. And it used to make me very upset. And I called the back office one day and I said, they had $20. They should be charged only one overdraft fee. They had money to pay all the small items that they paid for the same time and same day. And they said, well, no, banks don't do that. They always pay the largest transaction first because they think that's the most important one. And then they pay the smaller ones afterwards, because they may be the less important. I was like, they're paying them anyway, regardless. So might as well pay the smaller ones first so they don't get hit with all these $35 fees. But it was like an argument that had no outcome because that's how the bank policies are made and that's how they make money because they want to suck the blood out of individuals. So, and then students, they're young kids. They don't know how to manage their finances, so they'll be sitting there crying and sobbing. And I used to just refund half of their overdraft fees and I used to get very upset about it. And that's when I started studying. I recalled because when I was doing my master's, I took a class on Islamic economics, and I also learned a little bit about Islamic banking system. And then I started studying, and then later on, when I turned 32, 33 years old, I started studying my religion in depth. And that's when I realized there's a solution to this banking industry who's robbing people, but it's not going to happen because this industry is rotten to its core, and those people at the top, they get the benefit from it, and they're never going to let this happen. But what that taught me was that as an individual, I can control my own finances and I can help other people who don't understand how the banking industry works and how the economic system works and how the Federal Reserve and the governments work. And I can help them understand better and they can control their finances. So 3 ways the banks make money is by fractional reserve basis, by charging all these fees in overdraft and sustained overdraft fees, by charging the difference in interest in lending money and borrowing money, so that the difference in interest is their income. And also there are 3 ways the fiat currency is printed: by banks creating money by fractional reserve from nothing, out of thin air; by Federal Reserve printing money at the command of the government when they need money to circulate in the economy or flush the economy with more currency. And by federal government selling the treasury bonds and getting money from other countries and paying them interest rates. I hope this video helps. I'm going to end this video right now because I can talk about this for hours and it's going to be very confusing. So I think I'll let you guys digest this, take this in with a grain of salt, and I'll continue this point onward. I hope this video helps. Please give my video a thumbs up, subscribe to my channel, share this video with your family and friends and relatives who you care about. And be safe out there and invest your money wisely. Until next video, take care.